Welcome back to the Watch List. I'm Nicole Petallides. Jim Bianco, president of Bianco Research, is here. So glad to see you. I haven't spoken to you in a while. So glad that you're here. How are you feeling big picture about the market?
Oh, I'm not as pessimistic as everybody is about the market right now. I think that, we've lost sight of a couple of things. Trump is a transactional guy. I think that, when we get to Liberation Day, as we're calling it on Wednesday, it's going to be murky and it's going to be, unsure, and it might be this and it might be that. Nothing will be resolved. But that's kind of the point, is that he's a negotiator. He's an art of the deal kind of guy. I think the other thing that we got to keep in mind, too, about these tariffs is that the president of the United States, and I use those words carefully because it doesn't matter who sits in the Oval Office, holds all the cards. And so when I look at the markets and I see that the European markets are soaring and the U.S. market is falling because of the prospects of tariffs, it should be the other way around, because they're going to lose worse than the U.S. is going to lose. I'm sorry, I'm not trying to be upsetting anybody. And when Doug Ford, the premier of Ontario, says that he's going to try and inflict as much pain as possible on the American public because of tariffs, I'm sorry, it's going to be the other way around. The pain that is going to be inflicted on him is going to be far worse. That's the reality of the situation. So I think we're overstating the amount of tariffs. If you want an analogy, think of when we talked about with Brexit in 2016, that when the UK left the European Union, that was supposed to be the end of the financial system. It was going to, our financial business in Europe, it was all going to move to Paris and Frankfurt. It was going to be a depression for the UK economy. Nothing of the sort happened. And I think that that's really what's going to wind up happening here, is that we're way overplaying what these tariffs mean.
So, I mean, we're going to have lots of headlines as what everybody anticipates. April 2nd, we'll start to hear about the reciprocal tariffs, where the president has said he doesn't plan on giving too many exemptions or anything like that. Do you think that at some point the market gets more comfortable with clarity and understanding and can move back higher once again? Because obviously we've erased the gains of the year and since the election, and so people are feeling a little downtrodden. But the truth of the matter is companies are still doing okay. We're not in a recession. Where are we headed?
Yeah, I think, that the market is already starting to get comfortable with the tariffs. I think that, the bigger issue that we have is that this tariff talk has completely consumed the oxygen from the bigger story. And the bigger story is inflation. And the inflation predates Trump. So this is not a tariff-driven inflation. The PCE numbers on Friday were bad. The January CPI numbers were bad. We're running at a 4% inflation rate. We've seen some signs that, of unanchored inflation, like the Fed would talk about it, that people are looking at the possibilities of ever higher inflation, not just the University of Michigan survey, which might be overstated, but some other measures too. That's why I think if you look at the 10-year yield, we've had a 10% correction in stocks. We've had all this talk about recession is in tariffs. We're 425. Last September, when the Fed started cutting rates, the 10-year yield was at 360. Why are we not at least at 360 on the 10-year yield right now, if not lower, today? And the answer is because we've got an inflation problem. And so I think the market will get comfortable with tariffs, but then it's going to go back to the bigger issue that we have, and that the inflation issue never went away. This is not that it reemerged with Trump, is that it never disappeared, despite all of the prognostications from the Fed and all these economists that said we've finally solved the inflation problem. We never did. And we've got a sticky kind of inflation problem at around 3 to 4%. And that's a bigger worry, I think.
Do you think the Fed should be cutting again, or is that not the fix?
Oh, no, I think the Fed should be done. And I think that by the second half of the year, we might be talking about hikes. That's what I think. But the reality is, I think the May 7th meeting for the Fed is the most important meeting of the year. If they don't cut rates at the May 7th meeting, and there's only a 24% chance that the Fed's going to cut rates at that meeting, they're not going to cut rates this year. Given all the protestations about tariffs and recession and everything else that we're talking about, if they can't find that reason by May 7th, there is no reason to cut rates. And I think that that's what's going to happen. But, I'm a little bit more hawkish than the Fed would be. I'm more worried about inflation. I have been for a number of years. They're not. So I don't think that they're ready to start talking about rate hikes just yet. But if I was there, I would be.
So when you look at equities overall, you do think that there's opportunity, right? That there are going to be some concessions by some of the other countries. The U.S. is actually in a very good position. Maybe some of the other countries will not, or is in a good position. The other countries may suffer more with the tariffs, is your point. So are you buying dips? I mean, there was a time I remember talking to you about a lot of small caps, but where do you see opportunity?
Yeah, I think that there's a bigger rotation going on in these markets. I call it the 4, 5, 6 markets because I think over the next several years, you're going to see cash return you 4%. You're going to see bonds return you 5%. And I think you're going to see the indexes return you, like the stock indexes, the broad stock indexes, returning you 6%. So that's not necessarily a great number, but it's not terrible either. I mean, we've all gotten comfortable with 20% returns for the last couple of years, but that was extraordinary, and it shouldn't be repeated. But within that, while the indexes will return you 6, I think there is going to be some opportunity. Part of the reason I think that you're going to get 6 is I still think the Max 7 stocks have overhyped themselves, and they're going to continue to struggle, and they're a big part of the index, and they're going to drag the index down. So let me put it to you this bluntly. I think we're going to return to the 90s. And in the 90s, we had a brief moment there, the Peter Lynch era, if you will, where we had stock picking. And people were talking about stocks and rotations and themes and all of that. We've gotten away from that for the last many years because all it's been about is ETF, broad-based ETF buying. Buy the index. Is the index going to go up or go down? But I think we're going to be in a period where the index is going to be okay. 6% is not the worst thing in the world. But if you can think about stocks and think about themes and think about rotation, which, quite frankly, most investors do not, nor do I think they know really how to do it because they haven't had to, that there's probably better ideas there for you.
Right. And so with the picture of the other countries, you were talking about Canada and Mexico and Europe, do you see investment opportunities there, or you're more focused on what they need to do now? And the dollar, it fits in the story too, right?
Yeah. I mean, to take the second part first, the dollar, that's been an interesting one because Wall Street's done a complete 180 on the dollar right now. They've gone from, I'm old enough to remember January when everybody was saying that tariffs were going to be bullish for the dollar. Dollar was going to go up, and it wound up going down. And now they're just seamlessly saying, yeah, but tariffs are going to be bearish for the dollar. They did a complete 180 on it, not recognizing that they were saying exactly the opposite thing 60 days ago. So I do think, though, that we finally got onto the right idea that the dollar will probably weaken here a little bit. I don't think it, and I think we also way overstate the meaning of the level of the dollar coming down. Doesn't mean the end of the reserve currency or dollar dominance or anything of the sort, but it just means that the dollar will continue to come lower. And if the dollar is coming lower, that does mean, though, that for American investors to have some money overseas would probably be a better place to be. I think Europe is an interesting story, largely because it is a cheap market. Now, it was cheap for a reason. They've underperformed for 15 years. They've been a mess for 15 years. But if this tariff talk and concessions to the U.S. force them to start thinking more capitalistic instead of the old one used to use, where the U.S. innovates and Europe regulates, and they've regulated everything into almost out of existence, and they start allowing for capitalism to return to the continent, there could be a compelling story with cheap stocks in Europe, especially in industrials, and especially, say, in their burgeoning military defense or defense sector as well, too.
Yeah, we saw that as the new Mag 7, the defense sector of Europe. Really interesting conversation, and also that you think that the inflation problem was never really taken care of before Trump, and that you still think it's an issue, and that's why these bond yields are not coming down to 375 or 350 or whatever, that they're still in the 4 range, and that you think that there even could be the need for a Fed hike in 2025. Okay, Jim Bianco, President Bianco Research. It's always great to see you. Thank you so much for being on today. Thanks.